Good morning. I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm John Darsie, Editor-in-Chief, and together we bring you the Morning Call. So Scott, last week we had the strongest week in the market since December 2011, a blockbuster start to 2013. The S&P closed at the highest levels in 5 years. The last 2 days we've had a little bit of rest and digestion. Is this healthy type of action, or what are you looking to see at this point?
I think it's very healthy, and I've been out the last 2 days, so it's kind of funny to see the headline. I think we were down 1 or 2 handles, and it's like market off due to debt ceiling debate, or the market always wants to obsess over something, and the market was obsessing over the fiscal cliff, and you know what? It was resolved. And just like you said before, John, you said we had a very positive start to the year. 2 strong days with a big gap. So some digestion, what we call, constructive action, sideways action. That makes sense. And right now I think we're holding in just fine.
Yeah, on Monday we actually had the lowest volume full session since the day before Thanksgiving. So that sort of gives you an idea that investors and traders were taking a little bit of a breath after that strong start to 2013. And it also seems like investors were a little bit waiting for earnings season to get started, and Alcoa last night kicked off the unofficial start of earnings season. What did you see in that report that you like, Scott? And with bank earnings coming up, what do you expect from earnings season?
Well, people like to look at Alcoa. They like to see for demand for that, for aluminum, so to speak. And at this particular point, everyone obsesses over this stock because it happens to be the first big name that reports. But typically, it's somewhat irrelevant. It's nice to see that it was positive, and I know their guidance wasn't so strong, but I think they're going to get a pass for it. So there'll be a positive tone to earnings season. But really, the real action is going to start later this week, next week. So at this point, I think people are just trying to jockey their positions, measure their time frame, and see where the money's flowing and what they could put on. As we see digestive process, in that digestive process, that's when you want to find relative strength. That's why when you want to put on positions, and that's when new chart patterns get tight. So this way, when they expand, they give us entry points to get back involved with.
We were talking a little bit earlier, Scott, about how markets that start the year off very well typically perform very well for the entire year. And that's not something that we like to take at face value and trade completely based on a blanket statement like that, but it's definitely something as a trader that you should keep in mind.
What do you mean you don't just sell in May and go away?
we don't like to use those conventional wisdoms to make our trading decisions. We like to let the price action obviously do the talking, but it's something to keep in mind. The market had a great start to the year. We've had 2 days of great rest, and it could be the start of a great year, like you talked about in your 2013 predictions.
Which you helped with me very well.
I did help a little bit.
This is kind of unusual. Usually we're in the back room typing up content, getting things together. So it's a pleasure to have John Darsie out here showing his face because he's a very handsome fellow. But with that said, you go to actually the action right now. So let's take a look at some of the charts. Let's go first with the S&P and take a look here. You look at the chart of the S&P. Here is that positive 2-day move. This was the igniting bar on New Year's. What was this? New Year's Day, or the day before New Year's Eve, actually, when everyone was saying, "Oh, but we don't have resolution to the cliff. Why are we rallying?" You know what? We rallied. That's all you had to look at. Closed strong, gapped up, and we gapped above this trend line. So we stayed and gapped above this trend line. So we've had 4 or 5 days of healthy consolidation above this trend line. The 8-day moving average just caught up. We're still above the 21 days. So that means we are strong. If you look at the last rally we had on this gap up happened the day after that November 16th low. And from there, if you use this trend of the 8 and 21 day all the way up to this point, you rode a very healthy trend. So I'm going to right now try and do the same thing. The longer we stay above this line, now that we caught up, I'm going to try and stay with this trend. And I think we get in motion if we can get above 146.61 in the spiders. And then your next point of reference right here comes in at 148.11. And then a close above that, I'm not sure when it's going to be, opens the door for that 1,500 level that we could see later this quarter or before the end of the first half, so to speak.
All right, well, now let's start to focus on a more sector-specific type analysis. We've seen the market really rally despite some weakness from high beta tech, specifically a market leader like Apple. And it's actually a very encouraging sign for traders to see the market hold up and push higher in the absence of leadership from Apple. And Apple remains a little bit lackluster. Let's go to the charts and take a look at it. I know it's a stock you trade very often.
Well, this is the thing. There's the positive and a negative side of it. Positive to see that they've been able to put baby in the corner. You say nobody puts baby in the corner. I'm dating myself from the 80s. They put Apple in the corner. And Apple, started off after, in late September with that September 21st high where you had the head and shoulders top. And from there, it's just been a waterfall down. You had this nice reversal here, gave us a tradable move back to the 200-day where it felt, had resistance, came down quick. And then if you remember, in the end of December, we weren't sure, would it break 501 to 505? Can it hold? And then, this day was a nice break of this descending channel here. But what did it do? It lasted for a day and a half. Then we filled the gap. So at this particular point, Apple hasn't really changed its character in 2013, and we've been looking to see. So, if you go to more of the daily chart of Apple, you will see that, or not even the daily, we'll go to the weekly, the longer it stays close to this 500 area, the more danger, or the danger zone exists that it could break below it and see a 440. So I know earnings are coming out January 23rd. I don't think it's going to have a huge move before it. A lot of guys are like, what kind of strategy do I take into earnings? I'm like, there's a lot of trading between now and January 23rd. So at this particular point, I'm just going to take it day by day. I'm long a tiny bit, but if this thing starts getting below 520, I'm out of it. At this point, if the market's not showing commitment to it, you shouldn't, neither will I. And we'll talk more about a strategic earnings approach as we get closer, because who knows where it'll be by then.
Yeah, and it's like you said, I remember the Wall Street Journal article you were quoted in extensively a couple months ago talking about how Apple, the psychology has changed, the halo is gone from Apple. And I think that's a very important thing to consider. Investors are just a little bit shaky about Apple right now. In the past, they used to trust it as a swing trading vehicle and sort of trust reversals and use those as swing trading entries, when right now I feel like traders are using Apple more as just a short-term trading vehicle and focusing on that aspect of the trade.
And with that, just one last thing. I think they came out today and they said they're going to come out with a lower-priced iPhone. And I know people are chirping about it all over the Twitter sphere and whatnot. I don't understand that either. They were premium products. Everyone loves their products. The problem they had last quarter is they couldn't meet the demand. You know what? Meet the demand of your existing products. Have the iPad mini in the damn store. Have the iPhone 5 ready for people to walk in and get contracts. Don't come out with, oh, what's the next one? So then people wait to say, okay, maybe I shouldn't get the iPhone 5. Let me wait for this one. You know what? Meet the demand. I think you got to split your stock, and the management team has to start executing better and get its groove back. Otherwise, we're going to see a four handle in this stock, and some guys are going to get hurt that haven't been reading the tape the right way.
So in the absence of leadership from Apple, we've seen some other high beta tech stocks sort of take the mantle and take that leadership role. And you obviously have to point to Amazon at the start of any list like that. Amazon yesterday, or on Monday, extended to new all-time highs after an upgrade from Morgan Stanley. It's been acting terrific even before that. It's not necessarily that whippy electric type trade that we've seen from Amazon in the past, but it was grinding higher, holding up in the upper end of its range, and then Monday we got that extension higher.
Right. Well, Amazon, if you just follow it technically, acted much better from that November low. So if you look at the chart of Amazon, you will see when this descending channel ignited back when the market bottomed in November, it had a quick move higher, followed the 8-day moving average, went sideways. It looked as if it was going to break out here, break out above the old high, and it didn't. Some guys got stopped out when it broke below 255, but then right here was another way back in. And then, you take a closer look at Amazon, you will see that it had another nice little flag pattern right there. Okay, so, it gave you a reason to be long it in your portfolio approach, which I wasn't. And then you had the upgrade. I think it was upgraded again today as well. So I think at this particular point, in order for it to get back in motion, it's going to have to get above this 270. So right now it's grinding higher. You go to the monthly chart, shows you that you can be a stock picker. Congratulations. I'm telling you, congratulations if you've believed in this company, you've been holding it as a stock picker, because look where it is. It shows you that equities are not dead. Depending on your time frame, there was a lot of different entries. One right here, one right here. It's been trending. So at this particular point, you always want to trim and trail it on a short-term basis. I don't like the fact that everyone's starting to upgrade it now. I hate when the upgrading cycle gets a little crowded, because that means, who knows, are they trying to get rid of it before earnings? What does that mean? But at this point, technically, it's still acting very well. Just trim and trail, as I would say. And if you're a trader, or an intermediate market participant, know your time frame and be careful going into earnings.
And the last part of that key trio is Google, which hasn't been quite as strong as Amazon, but obviously last earnings we saw that debacle with the earnings leaked intraday from the people who print the earnings for Google, and you saw that big wide range down bar. But Google has really been able to absorb that move, shrug it off, and is climbing back towards its upper range. I know this was your stock of the year in 2012, Scott, and it was a roller coaster ride for Google, but it's come out on the good end of the stick, despite that roller coaster. Same thing again.
And you could have been sticked, if you were in there and you were like on the wrong side of it or didn't know your time frame.
Yeah, you have to take a short-term approach. You have to have a long-term equity approach, and you can't be stuck in between. And when fear comes into a stock or comes into a market, you can't puke it out. You got to stay the course and know your time frame, like you said.
Right, but if you don't have the risk tolerance, you just, you have to be realistic and take accountability for that, because some guys, bought Google wrong and didn't hold it as the first half of the year was a little bit choppy, whereas some people traded around it and waited till it was ready, and then finally it did go. So let's talk about where Google is now. You look at the chart of Google and you will see you did have, that day, that debacle day where you had a few minutes to get out of the stock as it was halted, and once it broke this key area, this huge, igniting move to the downside. When you have a break like that engulfs a big range, it takes time to repair. So that's what it did. It was repairing for these 8 weeks. And then, if you remember off the charts, this is when we started to focus on it, when it broke this descending channel right around 675. And that gave you a nice trade to 705. And then since then, PS, look where we are now. We've actually came back to where it broke down from. So it negated the strength and the power of this wide range bar. So at this particular point, it's following the 8-day and the 21-day. If you're a trend trader, I think this has been a nice one and you could follow it. I unfortunately have been just trading it more as a day trader versus holding it. I didn't choose this one. But at this point, I will look at it. If it starts to get above 741, I will try and look at this as a momentum trade above this level, and then we'll be back at prior highs. And then if they do come out and they perform on earnings, the reason why I loved it back last year was because of this tight channel. It's forming another nice tight base above where it broke out from. So at some particular point, this could take out 774 this year and be on that road to 850, which I thought would happen last year, but fell a little short of that.
So in your 2013 predictions, we're going to go back to that. One of the stocks that we did, and we published this on New Year's Eve, was Facebook. Facebook is a stock that last year it had a tough go of it, obviously, after its IPO. It saw its price cut in half after the IPO and really couldn't sustain any sort of strength. And on November 14th, I remember you tweeted before the open, you said, gun to head, I think shorts get squeezed on this IPO lockup expiration, and I think we go higher. And that's exactly what we saw. And we haven't seen Facebook really look back from that.
With that said, there's been times when it paused and then times when it went back in motion. And it was funny because I was heading to the airport that day. I think I was going to San Jose. So I traded it real quickly. And it was just such a beauty of this business. And if you're in here and you're watching this, you're trying to learn the business, is where there's not that many spots where you could all of a sudden, see some kind of tactic take place. And I think I was at my actually desk, and I started buying Facebook right when it opened, and it went up like 6% that morning. I made some nice money and I headed for the airplane. So that just shows you that, that guy on the beach in that commercial say, I'm trading from the beach. It could happen, but it doesn't happen all the time. But if you look at the chart, on a more intermediate basis, this was that day, if you remember, right here, boom. So it ignited. And then what was important about that is it held higher. This is when the trade actually started to look better, was when it held that and showed commitment to it. And then if you remember, another nice trigger was right around 24. And why did we like that? Because look, you had a gap here. We always love when it fills the gap. So recently, you had some consolidation. Someone's been drawing on my charts, and it descended into the 8 and 21 day, and then it just continued to the upside. It's holding above that 2860, which was the last buy. I think if it takes out this 2979, you'll see 30. And in that 2013 thesis that we had, what was the area we thought we can get to this year?
That pivot high up around in the $33 area is the area that we talked about, out of that cup and handle formation that we've seen Facebook create.
Okay, and there you go, the resistance. And we don't just come up with it. This was the last point of reference. This is where it broke down from when we were wrong. Okay, I thought maybe it would break out that this was enough, but it wasn't. That's when we got stopped out. We got stopped out here at 30.60. Didn't break out above the price level we were looking at. So right here, major resistance comes into play, kind of by this 32.50, 33. So at some point, it could get there. And if it continues on this path and their earnings are okay and they talk about their mobile strategy and this big invitation they sent out an invitation today to the media, kind of like Apple-esque, for January 15th. So look out to see what happens on that day. And you know what, who knows? If it runs into that day, sell the news. But obviously we're not there yet. So at this particular point, it's acting well. I'm still long Facebook. I'm trading around it, using a tier system that we talk about. And I'm going to continue to do so as long as it continues to act well.
Sounds great. We're going to have a quick commercial break here, and we'll come back to you with In the Trenches.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
We're back with the morning call in the trenches, and one sector that we've been paying attention to this year and that has really perked up so far has been the casinos. Las Vegas Sands, MGM, Wynn are usually the stocks we focus on in that sector. Scott, let's just not waste any time and go straight to the charts on these.
Well, if you remember, the first part of last year was very strong for the casinos, and then it peaked out, and then they started to act faulty, and it really fell off our radar. I would say, it was on my trading plan every day for the whole first, half of last year. Then it got a little faulty. But if you remember, in here we talked about that capitulation low in July. Okay, you might have talked about it in your editorial. We put it on off the charts, and it was a great great spot where it switched gears again. So the question was, we're going to get some attention in this sector going forward. So you look at the chart here real quickly at LVS. Here was that capitulation day. After a big move from, the peak here. Look at this red dog reversal at the high. Shows you that you can see pivot points. Sometimes you don't know what it's going to go to, but this one wound up being a big decline. Then you had this, this reversal right here. Look at that reversal that it never violated. I want to show you one other thing here. You put volume on. Look at I gotta show you the volume because the volume that day was immense. Look at the volume on that day. Look at that bottom. So that was a day to cover some shorts, maybe get long, and then you had a nice move back to resistance, and then from there it needed time. With that said, another nice channel, and the stock actually loves to channel. Channeled, broke out above 47, moving to the upside, looks really good. Win right now, I think you have a tradable spot right here that some of our guys are watching. So if you want to write down, we might even have it on the price point sheet today. Nice tight pattern right there, flagging, big gap up in the beginning of the year. This stock gets above just say, 122.21, and I think it continues to the upside. And if you remember, people laughed at me, I think, when I talked about MGM. MGM does move from time to time, and I know from guys who are in the virtual trading floor, you guys saw me long right when it broke above this area. Unfortunately, I think I sold it near 12, which was a nice move then. But then that was one of the problems I talk about here all the time is if you sell well and don't get back in, how well did you do? And now MGM's at 13 bucks. Really nice move on the radar. You go to the monthly chart and you will see that MGM on the monthly chart actually, look at this coil right here. Look at this nice little coil. So I would say if this group stays hot, there is a small chance this thing could see $18 or so. I know it was upgraded the other day to 17 at some point this year, but right now it should stay on your trading plan.
Yeah, and I was reading this morning when I was going over the news that MGM just got approval from the Macau government to build a new large casino in China, and that's one of the big growth engines for these casinos is Chinese gambling revenue.
No, they don't really love to gamble, do they?
No, not at all. All right, we're going to go into some quick hits here very quickly. Bank of America has been the bank stock that we've been pointing to and listing most on the price point sheet and off the charts. Around the $10 area is the area we were stalking. You had to be really patient with that trade and stick with it to get that breakout above 10, but since then we've seen a 20% move, which as a trader, that's obviously what we like to see.
All right, you're taking some words out of my mouth here, Darsie. I know we do this together here, but at this point, I think it was actually downgraded today, and a lot of people were saying, "Oh, why aren't you flat MGM?" Because again, we talk about if you go flat, you can get back involved, and I do think at some point this year it's going to go higher, and it just shows you these different patterns require different tactics. If you go to the chart of Bank of America, like you just said very eloquently, here is when you got into your core trade. Nice channel, holding higher, was showing relative strength. A core trade could have happened around 995. Here's your breakout. Then you sell some, and then from here, you probably take some profits as it continues higher. So now it turns into a stick with trade. Here is your core, and then you peel it off. And then at this particular point, wind up going sideways, going again. It's above the 8 day. I think there's a small chance, my voice just went higher, that it touches the 21 day. And at the 21 day, if you missed this move and did not chase and you were patiently, I think you can come in and buy some back. I know that I will get big again around this area at this particular point. I'm still long Bank of America, but a lot smaller than I was at most of the time during this move, and that's what I call trim and trail. Have you ever seen me say trim and trail?
Oh, never.
Never.
Never on Twitter, especially.
Never.
All right, we're going to quickly move over to gold, which is in a very interesting spot right now. It's really hard to call gold from a macro perspective right now, but yesterday we saw some strength. Scott, what do you think we could see with gold at the beginning of 2013?
At this point, anyone who has opinions are just opinions because it hasn't shown you what it's wanted to do. On a macro sense, you look at the monthly chart, yes, it'll say it took 2 years off. on a micro trend, it's really just, you know, not in play, no reason to be, you know, on a trader's radar, so to speak, or at least that involved. So we talked about 158.5 in GLD as major support. Even that day when it got below it, by the time it opened, it was above it. So if you use that as your don't cross line, it held. So big support still intact. There's still two downtrends that it hasn't even tried to break above. You look at the chart here, you know, here's one from this peak. So really, I don't think any intermediate term traders are going to start getting interested until we see a close above 164, which we might not see. But anybody saying that gold's going to get to 2,000, 2,500, it's going to have to break these two trends. One right here at 164 in the GLD, and then another one around 166 from the high here. And then from there, you got to go even further. You have a whole another set of resistance that you're going to have to deal with gold, which comes in at about 1,800 an ounce. So at this particular point, it's just in no man's land, and I don't think it's worth that much of your trading day time. So at this point, watch out of the corner of your eye. If it breaks this big support, I would get out of the way, because then the next huge support comes in down here around 148, 150. So at this point, gold has a lot to prove for both the bulls and the bears.
And obviously what the Fed does is very important to gold, and a couple weeks ago we saw in the Fed minutes that several FOMC governors are having the opinion that QE could end sometime in 2013. So
they can take it away?
Yeah, they can take away the punch bowl, Scott.
Oh my goodness! What are we
but
gonna do?
You know, it'll be very important to see the sensitivity of gold to those rate changes and to even the Fed minutes, because seeing the details and what they talk about at those meetings can really trigger big moves in gold.
Right.
Finally, we're going to talk about the long-term bonds. The TLT and the TBT. I know you're long TBT, and over the last 2 days when the market's rested, the TBT has pulled back into its 200-day moving average, and that'll be the key level for us to watch. I'm taking words out of your mouth again, Scott, but go ahead to the charts. I live in your head.
You usually have a fundamental lady that's here, gives the fundamentals, and I go with the technicals. We're both technically schooled, and we have a fundamental thesis behind us. But this is a trade that actually changed. A lot of people have been trying to find that TLT short trade, that TBT long trade for more than 3 days, because last year maybe you got 3 different days where it worked 3 different times. So at this point, I think for the TBT to really show that there's going to be commitment here, it's got to hold a big percentage of this gap. But just like anything, you got to use a tier system, and when it ignites, you go with it. When it gets a little overbought, you sell some. And if you look at the chart here at TBT, you will see, this is when it ignited. It ignited right here. Look at this wide range bar, took out this descending channel. You didn't have to find the bottom, and that was a nice area to get involved. Okay, and then you had this big, gap up, and I think I actually got involved, when it crossed above this spot right here. Okay, and then I do remember coming into this area, I tweeted, I'm like, you know what, this is probably not a spot to chase or a spot to press TLT to the downside. So if you didn't and you were waiting for a pullback, here you go. Okay, this was a small red dog reversal, so on a micro level, when it pushed through the high here of 66.86 and came back below, that was a short-term sell signal to get rid of some if you had a lot on from this area. So if you got rid of some and you still have some, this is a spot to potentially add, especially if it protects this 64, 68 area. It could tail into it or do something kind of tricky, but I would say as long as it doesn't close, hear my language, close below this gap, I do think that it'll make it easy for guys like me to stay with this trade.
Yeah, I think in general we look at that bond trade as evidence that more people are getting excited about equities. We've said for a long time, you always say equities aren't dead. You have those fear mongers out in the market that scare people out of the market, but you're seeing the bonds, money rotate out of bonds and a little bit into equities, and that's a very important trend to consider, and it could provide us some upside for the market in 2013.
And the money from the sidelines that everyone talks about.
Yeah, exactly. We could see a wave of money coming to the market in 2013 as perhaps economic growth starts to pick up and stuff like that. Who knows where we can go.
Right, and that's when you have to look at levels. And at this particular point, I still think there's a lot to like in equities. Some indices are at 5-year highs. You saw the headlines that were the highest close since the financial crisis. So it goes to show you that a lot of money could have been made buying after the financial crisis. A lot of money could have been saved for you when you saw the price action just really pitiful. And here we are about 6% away from all-time highs. So even if you've missed everything, it doesn't matter. Start making a change and work on your approach and think about, are you a macro investor who's in your 30s that wants to put monthly money away for the next 20 years? Probably works for you. Are you an intermediate trend trader that wants to catch a move? If we're still holding the 8 and 21 day and we take out 1474 and we go on our way to 1540, 1575, you got to figure out where you want to live. But at this particular point, I think the market's very constructive, and I think that there's a lot to like In earnings season, you have to know what's coming out, when it's coming out, where the stock was, where it's looking to go, what's your risk tolerance if you could hold. Perhaps use an option strategy that we talk about, because risk in options is premium paid. So that gets you out of the way of what could be a disaster earnings report. Then we're going to have to see also, if the earnings are bad, does it get discounted? Does it get a pass? Do they rally bad earnings, or do they open it lower and do a gap and go to the downside? Or the same thing, a lot of these stocks are at their highs. What if they come out with good earnings and sell them? So there's a lot of different things to consider in the earnings season. We'll help guide you through. So this particular point, thanks for joining us. And just tune into the recap. We'll go over what worked, and we'll take a little peek at tomorrow. Have a great trading day.